All right, everybody. Welcome to Finance Friday here with Jerry Fetta, owner, founder, CEO of Wealth Dynamics, and my one and only co-host, Neno Aquino. What's up, Neno?
Hey, what's going on, Jerry? Good to be here as always.
Yes, sir. So we're going to be talking about some great topics tonight, actually. One of my favorite things to go over. But before we dive into it, I want to make sure that we start things off the right way. So Neno, do you want to lead us off on our usual?
Of course, let's go, go over a couple of, some ground rules here, some of the basics as we start off to basically have a mindset, right, for diving into this. So a couple of things here that I want to go over. Number one, have a purpose for attending the meeting. Now, as redundant as this may sound, it's like a purpose would be a reason for doing something. So I want you to ask yourself the question, right? What is the reason in which you are attending the webinar, either live or at a later date, right? Either as a recorded version. So what is the reason that you're trying to do this? Now, truth would stand to reason that if a person is attempting to gain some kind of a knowledge in an area, you will indicate there's something missing, right? It's some form of application or some type of improvement that I need to better, right? When I take a look at my statistics in an area, right? If they are somewhat down, in order for me to improve it, I'll need to first do what? Acquire the knowledge. Now, in order for me to acquire this knowledge, the demonstration that I have this knowledge would be the application of it, right? So you'll be the equivalent of me saying, hey, I know how to bake a cake, but when I go bake the cake, it doesn't turn out to be a cake. Therefore,
chicken comes out of the oven.
Therefore, I don't have the knowledge, right? Plain simple. So when I take a look at finances, and okay, I'm trying to do X, Y, and Z, and if I'm not getting the result that I want, there's some underlying factor that would be related to knowledge that does not give me what I'm looking for. So that's first and foremost, right? I need to have that very clear for myself. What is the reason why I'm doing this? Okay. So which means is look for ways to apply the information. So as we're going to be giving you data here, it is going to be very much to the standpoint of how can I apply this? How can I get this piece of data and be able to bake a cake and get my product, which my product would be a cake, right? So ask questions. If you do have them, do we want this to be very interactive here throughout the course? We're going to be, very big on the definition of words, because when it comes to building wealth, a couple of things, right? Beyond your work ethic, your ability, you got to be able to understand the definition of words, and you got to be able to add, multiply, subtract, right? Simple mathematics. Now,
And divide.
And divide, right? So
not in a political sense, though.
So in a very simplistic manner, right? And for the most part, we have what? We have like a phone that's able to do that for us, right? So we don't even have to rely on that. So, but point being is, okay, good. I got to have that in mind, right? Now, and I do want to address a few people that are going to be here attending the webinar. One is going to be some of the staff, right? Some of the people that are going to be also ongoing clients are going to be wanting to improve what? Improve their area, the knowledge in this area. Why? So they can increase, right, the statistics in such an area, right? To continue getting a betterment of improvement, especially, again, for this staff, from a standpoint of delivering services to you faster, more efficient, so on and so forth. Now, you as a client, if you are attempting that by now, ideally, right, you are following this right here, the blueprint of financial freedom, which would be what? The sequence of steps in order for me to actually attain financial freedom. Now, I'm going to give you how, the instructions on how to get the book, which goes back to the very first point that I mentioned in the beginning of the call, the reason why I'm doing something. Now, for the more seasoned clients, the reason that I can actually say this, because I've talked to many of them, they're attempting to follow, and actually not just attempting, they're actually following the program, is the reason because they want to become financially free. Becoming financially free by duplicating the exact actions that the wealthy have done, which would be what? Not an opinion, the actual results, the factual results, which is what? The cake. Right? In the analogy that I gave it earlier. So with that being said, in this book here that Jerry compiled together here was the data, not opinion, the data, right, that the wealthy have done in order to accomplish this financial freedom, which you may go to jerryfetta.com/B2F. I'm going to drop here the link on Zoom and Facebook as well, jerryfetta.com/B2F promo. And guess what? As you get the book, I'm going to be reaching out to you to engage in a conversation. right? There's a vast amount of information out there, included in the book as well. But in order for me to be guiding you in the sequence, the equivalent say, hey, before, hey, let's, instead of dumping everything into this bowl right here, right, with the pan in order to bake the cake, how about we do in a sequence, right? So that's that, right? Now, if you're more of a person who's trying to find out more about who we are, so a couple of things to be aware, right? So if you're attending this year, okay, you're trying to figure it out who we are and so on and so forth. And as you're trying to study, now, whenever I'm studying something, right, a couple of definitions that I also looked it up here for our call is going to be, what is the study? Is going to be the devotion of time and attention to acquiring knowledge on a subject. So if I'm going to devote my time and attention to acquire knowledge, now, how do I determine if I have knowledge on such an area? By the results. Which means if I don't have the result, that I don't have the proper knowledge, which means what I need to actually study to acquire the knowledge. Goes back to the very first point that I said, right? Now, a few things here on that as well is my ability to confront such a thing. One of the things that Jerry and I are going to be going over this call here today is let's go ahead and face things for what they are. Now, many people, right, basically America has been marketed to what this concept of financial instruments, financial products. And when we take a look at that, a couple questions that I'm going to be raising here to start the call is, why am I following them? What is the reason that I'm following them, right? And so this is as much as I'm going to leave for right now, is because we're still going to dive into the call here. This is just some of the ground rules. And last thing here, share if this helps you, right? Let's have a purpose. Let's go ahead and look for ways to apply the information, ask questions, look for, be engaging, and share if this helps you. And get the book.
Get the book.
Right? Exactly. So that's some of the ground rules here.
Thank you so much, Nano. And we're going to talk about something that Nano and I are we talk to a lot of people about this, so we're pretty well versed on this subject. But it's really, the idea of becoming your own bank. You've heard of, the infinite banking concept. We call it the sacred account. Maybe you've heard of cash flow banking, but it's the idea of becoming your own bank and using that to generate passive income versus, the traditional retirement concept, right? And so for me, I learned it the first way. And this is how a lot of people learn it, is that you put money in retirement accounts and you build them up until you're 60. And then when you're 60, you can retire and you draw for these for income. And, hopefully you never run out of money, right? And so when you look at this, it's like, okay, this is what, a lot of people are doing, what a lot of people hear about first, and it's kind of the norm, right? And then there's this other approach, which is we're talking about tonight, being your own bank, right? Like kind of different. Most people don't ever hear about or think about being their own bank. I know growing up, that was never something that was ever on the radar for me. How about for you, Nano? Was that ever a concept for you, like as a kid, a teenager, a young adult, anything like that?
What was the concept that you were asking?
The idea of becoming your own bank?
Not at all, right? It's funny because as growing up, as a matter of fact, I don't know if you ever had this. I have a picture in mind. I literally have a picture in mind of a little pig, right? That was supposed to be my bank, right? I was taught to put my money in a piggy bank, right? Always in the concept of putting my money elsewhere, like in a regular bank or a piggy bank, but never as the infinite banking concept, but rather quite the opposite.
Yeah, and that's really, like we get taught from a young age to give money to banks, right? So when you think about becoming your own bank, it's like, okay, well, for me, I set up my first checking account, I think when I was 15 or 16, right? Like Nano, I was, doing the piggy bank thing. For me, it was a jar. It was literally just like a jam jar with quarters in it, but we still called it a piggy bank, right? And so we're talking about, no, become your own bank, right? And use that to, all the things you would do with the bank, you do with yourself. Now use that to build wealth, you use that to build passive income. And so what we want to do tonight is we want to give a real comparison of the two, right? Because there are two different ways you go. I would say there's three, because there's always the do nothing party, right? So you could do nothing and you'd be very successful at doing nothing. You could also do the, how do I become my own bank and generate passive income? For me, that's been a very high degree of success. For a lot of others, it has too. Then there's also the traditional routes of retirement and mutual funds and 401ks and all this stuff. And a lot of people use it, right? But the question we want to pose is, which one is actually the most successful, right, Nano?
That's correct. Whenever we take a look at the end of the day, and here's how do we measure the success, right? A couple questions to ask. You pose a question here, right? Or you should put in a statement, right? Oh, should I become, my own bank or this and that? Now, here's the question. Why, very valid from both viewpoints, why would I put my money in the bank? And why would I create the idea of the infinite banking concept, something for you and I to think about. Because if I had been taught my entire life, okay, the snap answer could be that's just what we do, right? I put my money in the bank, right? Now, conversely, right, if I'm going to be using life insurance or the infinite banking concept, I bypass this and use the such thing he called the bank, right? The life insurance as my infinite banking concept. And as again, looking up words, right? When we look at that from time to time, when I'm dealing with people, because it is a bit of a foreign subject, they're like trying to understand, right? Because perhaps they have just been exposed to it and they, okay, this makes more sense, but I have been so ingrained with the data that I have been taught and studied, right? The knowledge that I have up until however old I am, 30, 40, 50, you know, however old you are. And it's like, oh, you know, then like they're struggling. But at the end of the day, how do we measure the success, at least in this area, would be to the individual who are actually have winning in the game of finances, which would be the banks itself and the super wealthy, right?
Mm-hmm.
So if they're winning, what are they doing? Because everybody got 24 hours in a day. So what is it that they're doing, right, in regards to that?
And I can tell you, they're not buying their own mutual funds. You know what I mean? Like you go to Wall Street, they're not buying their own stuff. It's like, you know, you go to a drug dealer, like don't ask me how I know this, but the rule of drug dealing is you don't sample your own stuff, right? The rule of Wall Street, you don't buy your own stuff. You go to a bank and you say, hey, I want to take a loan out to buy real estate. They're going to be like, great, like show us the property. We want to loan you money. If you go to the same bank and you say, hey, I want to take a loan out to buy mutual funds, they're not going to give you the money for that. Right now, to add to what Nano said, so for me, this is how I look at it now. Back then, I looked at it this way, right? When I was a financial advisor selling mutual funds, I looked at it this way. I was like, okay, which one's right? Which one's better? Which one is, you know, the more acceptable one? And it was all about which one should I do, right? So I would compare the doing this. So if I do this, then I can put in, you know, my 401k, I could put in $18,500 a year. I could put in $6,000 a year in my IRA. And, you know, I could do this mutual fund, that mutual fund. And it was all about doing, right? And then I looked at the passive income one and I was like, well, I don't really know how to do that. Right now, you have to ask yourself when you're in the world of finances, and this really goes for anything, but it's especially true of finances. How do we learn this stuff? Where do we get the knowledge from? Why is it that me growing up in Alaska, you know, 18, 19 years old, I understand mutual funds? Why would that be? They didn't teach that to me in school. That wasn't something my parents talked about. The only reason why is because it's so well marketed. Literally the furthest state in the union away, and I knew about mutual funds because it's that well marketed, right? There's nobody pushing the other stuff. There's nobody saying, let's spend billions and billions of dollars per year for decades and decades and decades to teach people to break out of the banking system. That's not happening. The reason why is the people that are spending the advertising, they make money on the banking system. They want you in it. They want you, borrowing. They want you giving money to their mutual funds. They want you putting money in their retirement accounts, right? So we have to look at this. If I'm comparing the doing, my main point is here, I have to compare it equally. I have to look at, okay, well, which one do I actually have familiarity with? And why do I have the familiarity? And familiarity doesn't mean correctness. It just means that's the one I know about. Right? Everyone here watching tonight, you've had an experience where you thought you knew something one way, you thought that was the right way until you learned something else. And then you learn the new thing and you're like, oh crap, how come I didn't know about this before? And it's simply because you weren't familiar with it. Right? Now, before the familiar period, if Nano came up to you and was like, hey, what you think is wrong and there's a better way, you'd probably be like, Nano's rude. Of course I'm right. My parents taught me this. My teacher taught me this. My whatever taught me this. And you'd be closed off to the reality that there's a different way of doing it until you see that that different way is actually better. Right? So for me, I was looking at it, I was like, okay, well, I'm going to do this one or I'm going to do this one. And I was comparing the doing and the doing and the doing. I don't look at it that way anymore. Okay, when I'm looking at it, I start with what do I want to have? Right? Kind of to go back to what Nano said, what do I want to have? Right? So a big part of my story, guys, and if you've watched for any period of time, you know this, I was a financial advisor in Wall Street for 4 or 5 years, did very well at that. I was actually my mom's financial advisor. And what's the story that we're taught on Wall Street? We're taught that you send the money to the retirement accounts. And then when you're 60, you can retire and live off it all. And life is going to be great. And you can go to the beach every day and live in an RV, right? So my mom got diagnosed with cancer when she was 60. Okay, 6 months later, she passed away. And so I was her financial advisor telling her like, oh yeah, when you're 60, this will work. So I watched it unravel and not work with someone that I loved very much. And I looked at this and I was like, okay, well, what if it doesn't work for me? What if it doesn't work for Nano? What if it doesn't work for the next person? Like there's got to be a better way than just wait till you're 60. Right. So I started to see, like, for me, it wasn't even what I did want to have. It was what I didn't want to have. I saw that and I was like, I never want to have that happen again. Right. That planted a seed for me. And if you're watching this tonight, you've probably had that seed planted in your mind where you're like, okay, there's got to be another way. You might not know it yet. This might be your first time you're hearing us talk, but you're now seeing, okay, there might actually be a different way to do this. So I'm looking at, okay, well, this is what I don't want to have. And so what could I have instead? And based on that, then I start learning about things like passive income. Then I start learning about things like what the wealthy are actually doing. Nano mentioned my book, right? Blueprint to Financial Freedom. Okay. This is not my stuff. This was literally the last 10, 11 years of me researching what do the top 1% of wealth actually do with their money, and then doing it and seeing it actually works and then putting it in a book, because the biggest thing missing for people isn't even the knowledge of what to do. Right? Like you can Google, you can TikTok, you can Instagram, you can YouTube. You're literally on a Friday night course for free tonight learning about it. You can get this information anywhere. What I saw that was different and what was missing was the right sequence. Right? Like Nano had mentioned, if we go back to the baking example, like pretend you've never seen baking before. Like you're giving, the ingredients for brownies to a caveman. You have to realize the guy has no familiarity. He probably doesn't even know you're supposed to crack the eggs. So if you grunt at him and point like eggs in bowl, like he's going to throw the shells in too, because he doesn't know any better. And that's how a lot of us start with finances. We have no context. So we hear, oh, the top 1% do the infinite banking concept, or they do this, or they do that, or they buy Tesla, or they buy Bitcoin, and we just go do it. And we're like the caveman. We've got no context. We've got no idea whether or not we're supposed to crack the eggs. And we just throw it all in the bowl because that's what we hear. Right? So this having thing, what do I want to have? And for me, what I really want to have, and what I think most people on here want to have, is financial freedom. We want to have the ability to no longer trade time for money, right? Like you can't get the time back. Okay, money is infinite. They literally just they printed, what was the stat? They 20% of dollars ever in existence last year.
Yeah, I saw some of the
40%.
40%, close to being the 40% or more, the past 2 years.
So that's really like, you look at the time versus money thing, you can never get the time back. The money, they're going to create more of it, more and more and more and more of it. So for me, I had to look at it at a certain point. I was like, okay, I'm not going to trade my time for this anymore. Okay. Not saying I'm not going to work, not saying I'm going to be lazy, but I'm saying that that's not going to be the carrot and the stick no longer happens. I need to unplug from that. You were going to say something, Neno.
Yeah. So just from that perspective, for me thinking, right, hey, I want to be able to have this financial freedom and so on and so forth, which kind of begs the question, if I'm not financially free, what am I? Right? I got, okay. So it's a hard question, right? So I got to be thinking here, right? Versus just giving you answers. Let's think it through a little bit. So if I'm not financially free, what am I? Okay, to a degree or another, I am not free, financially speaking, right? Which kind of implies just about in every single area of our life, because we need money to survive, right? So with that being said, right? Good. Now, if I'm not free, could it be there are some traps along the way? Jerry mentioned here, right? Hey, they have been marketing this like financial products that's, pushing from a systematic standpoint. And by the way, this information is on the book, right? Just right here, page 13, something happened, right? First of all, 1913, what happens? Federal Reserve Bank comes into existence. And what do we have here? This graph right here shows the statistics of the individual. I don't know even if you have that handy, Jerry, the graph, perhaps we can show it.
Yeah, let me find it.
Right. So which the statistics showing after that point, 1913, what do we have? The wealthy impose upon themselves 40% savings, called the 40% rule. Why? Right? So we were talking about the wealthy, the group that has what? The cake. Perfectly well done, right? So if they have this, okay, why is this 40% rule in place? There you go, right? 1913. So this is happening. right there, 1913 happening. So, and what happens as well as a sequence of steps, again, historical data, facts, not opinion.
This is not me and Nano's opinion at all.
So
I mean, it is because it's the facts.
so here we have as well, 1929, what's happening around the area, right? We have the Great Depression going on. We have the stock market crash. As a result of that, what do we have? Securities Exchange Commission that happens. There you go, right there, right? Securities Exchange Commission happens. Now we have to have this SEC, the Securities Exchange, right? They put in place the act that all investments need to be registered through them in order to protect you and I, right? And here we go again with the ability to confront the things for what they are. Here we have now, as a sequence of that, right? After investigation and hearings, what was determined was that this group of individuals were the ones that caused the crash to happen, right? Taking advantage from people in the stock market. Here's and which begs the question again as well. Why am I putting my money with this in groups of individuals? Is that the right thing to do? Is that what the successful people do? And I mean, success, the ones that have the statistics. You may know a person who could be well off, right? That has put their money there. But the truth is, statistically speaking, from America, right? We got 80% of people living paycheck to paycheck. Right? We're not talking about the exception here. Now we're talking about right there, the wealthy. What are they doing, right? And again, going back to this, it's like just pure facts. So this is happening. And outside of that, what do? Let's put an exclusion to the side for what? The unregistered securities. For nonetheless, then accredited investors, right? And that's one of the things, by the way, that I talk quite a bit with individuals, right? Whenever they get the book, a couple of things. Hey, let's go ahead and just become aware first of there's a big picture from a systematic standpoint, aware of what's going on, because why we got to be thinking with the end goal in mind, the reason why I'm doing something. If I'm just simply looking to get the life insurance product, might not be the best company here to help you. We'll help you again, but how about we actually doing things in sequence in order for me to actually become financially free, which is the end goal here that we have from as a company to you as a client.
And really, guys, what Nano's going over on this point is like, you know, it goes back to what I said on the due. Like, even with something like a life insurance policy, it shouldn't be due, right? Like I don't want to just have a life insurance policy to do a life insurance policy, right? Like, what's it connected to? And so for me, like when we talk about this, we have an equation that we always go over with our company and with our clients. It's called PI greater than set, right? Passive income greater than savings, expenses, and taxes, right? So if I'm trying to achieve this, if I'm trying to have passive income greater than savings, expenses, and taxes, I've got to look at which one actually gets me there, right? Now, here's the thing. If I do mutual funds and I do the retirement thing, this is called appreciation in investing. It means that I buy a share, right? A share of stock of whatever company, right? Let's just call this ABC company. And I'm hoping that it goes up in price over time, right? And as it goes up in price, at some point, I want to sell it off for income. Now, the problem with this model is I no longer have the share of stock. It's gone, right? What happens when it's gone? Well, I can't keep selling something I don't have. Therefore, I risk running out of income, right? Not only is it gone, while I have it, it's in with Wall Street. Like Nano's reading a book on Monday. You're on Liar's Poker still, right?
That's right.
Yeah. So and Nano is going over this with our clients. Like this is who your money's with, right? Like it's not something you should want to have happen. You shouldn't be trusting these individuals. So not only is there a problem when I sell it, there's a problem the entire time it's being invested, right? So I'm looking at this and I'm saying, okay, like if I have to sell it, it's gone. That's no longer passive income. The other problem here is not a passive income producing investment, even from the standpoint of income. So with a share of stock or with a mutual fund, it has what's called a yield, right? So I could sell it or I could keep it. If I keep it, it's going to give me a yield. That yield is typically going to be a dividend, right? And so the average yield on a share of stock is going to be like less than 2%, right? If I get a really good one, a really, really good one, like an AT&T or one that pays a high dividend, maybe I'm in like the 4 to 6% range, right? But here's the issue. Like, let's say, like, Nano, what's a number people often tell you for what they want in passive income?
It's funny, the 10,000 number, it can be, a pretty common thing.
10,000. That's
Yeah.
the one. So 10,000 a month. So if I want an investment that's going to pay me a yield of 10,000 a month, and I'm in the stock market making 2%. And again, that's not the return, that's the yield, that's the income, the dividend that it's paying. I'm not saying, oh, the market went up or it went down only by 2%. No, I'm saying if you don't sell the thing, apples to apples, because when we're doing passive income investing, we're not selling the asset. So we have to compare the same scenario. If I keep the real estate, if I keep the sacred account, I'm not going to sell them. I'm only going to live off the income. So let's look at the same thing with the stock. So if I'm making a 2% yield, that means if I want to have a $10,000 a month income, which is $120 a year, at a 2% yield, I would need to have $6 million invested.
You become a qualified purchaser.
Okay, $6 million invested at 2%. That's going to pay me 10 grand a month. Right? So again, back to have. How am I going to get this? That's really what I want. Like, that's my goal. Okay, I want to have $6 million. Well, how am I going to get there? Right now, if I take the same 10,000 a month and I do a real estate deal that's paying me 12%, and on top of that, I'm using a sacred account, I'm using life insurance, and I'm making a positive profit spread on my own policy loans of another 2%, right? Then I'm making 14. That's my net return. So if I have $120,000 a year on 14%, I only need, and this is going to be a little bit dispersed up here, but I only need $857,000 to pay me 10 grand a month. Okay. So just think about this. Like, which one's easier to get? 857 or 6 million? Right. I like 6 million better. I would prefer 6 million, but I want 6 million invested the way this is invested. I want 6 million here. Okay. Now, if we go back to the idea of selling, okay, well, you're like, oh, Jerry, that's not real because you can sell. Okay, cool. So you're selling them now. Right? The average retiree runs out of money within 10 years. It happens. You're selling shares. It's no different than eating all your groceries. Like, don't be surprised when the food's gone. Right? It's going to happen. So if I'm selling and selling and selling and selling, okay, I'm putting myself at risk every time I do that. Versus if I do this over here, I never have to sell. Like, realize there's a difference between selling off and never having to touch the money you invested. You're only living off the income. Okay, one of them creates wealth. The other one maybe lasts 10 or 15 years. Right? So this is really, like, when we're talking to people about this, this is really what we're talking about is, okay, which one are you trying to achieve and which method actually gets you there the easiest? And so when you're using like the infinite banking concept, you're using the sacred account, there is a learning curve, right? You do have to invest time. You do have to invest money. You do have to get educated. But I would say that that learning curve exists probably, Nano, tell me if you agree with this, probably just the same with Wall Street, if not more. You've just been marketed to that you don't need it.
100%, right? Now, when we take a look at this, a couple of, again, definitions, just basic understanding of a financial advisor, right? Like, so what does that mean, right? Now, it would be a person who is employed to provide financial service or guidance to clients. By the way, this is data, right, that you have actually compiled together in different articles. This is the kind of information that you as a client, whenever you have, imagine I have I'm going to brag a little bit, like an issue. I have a walking financial encyclopedia that I can text, which would be myself or Jerry. Jerry, you know, he's part of the handling on more of the bigger stuff now. But like, hey, Nano, I'm dealing with X, Y, Z. Read this. Take a look at this video. Like, give you the exact data. Now, why is that powerful? Let me give you an example, right? I'm talking to a guy that reached out, bought the book. I reached out to the guy immediately. Hey, just want to introduce myself, so on and so forth. So let me know what you'd like to get out of our call. The guy gives me a rundown what he's going through. Hey, by the way, I'm making this, this, and this, and I'm doing a rollover over 401k to a new to my new place, and I'm just waiting for the funds. I'm like, for the love of God, take a look at this data here first, right? Why? So you can actually be in control of it. That it is going to be the power of having this proper information with this, right? Now, so with all that, right? Good. I gotta have this type of information in order for me to make the right movements, right? The right sequence of steps in order for me to have the thing that I want.
Yeah, and I had a call today with a guy like this too. It's a really good point to bring up. Is like, so when I was a financial advisor, if we talked, it was because either I was trying to sell you more mutual funds or I was trying to convince you not to sell the ones you had. Right? Like that's like, think about it. If you work with a financial advisor now, whether it's Edward Jones or Merrill Lynch or New York Life, whoever, is that not the case? Right? Like if they're reaching out, it's either because they want you to buy more things or because the market's down, they're trying to convince you not to sell. That's the conversation always, right? So that's how it was. And now, for example, I had a guy call me today. And like Nano said, like having someone like me as a resource, someone like Nano as a resource. We have a staff of like 15 people. Like we have tons of people you can call, text, talk to, whatever. But this person I'm talking to today, and we're talking about the exact concept we have right now. He's got 50 grand. He's putting it in his sacred account. He's going to borrow against it. He's going to do a real estate deal that pays him 12. Right. So I was walking him through this and I was like, okay, good. So the first thing you need to understand is that the money, when you deposit it, it's growing no matter what at a 3 to 5% average annual return, and it's never going to lose. Right. That's the first thing you've got to realize. You can't get that anywhere. You can't get that at the bank. You can't get that in the stock market. There's nowhere else that this exists. Not only is it growing like this, it's the safest place you could put money, right? It's not taxable. It's guaranteed against loss. It's guaranteed to grow. Not only is it guaranteed against loss and guaranteed to grow for 150 plus years, that's all it's ever done, grown and not lost, right? It's protected against creditors. It's protected against lawsuits. It's protected from Wall Street. It's not in the markets, right? There's not a bunch of like management fees and stuff coming out of it. Like it's the safest place you can put money. And so I'm explaining this to him. And I was like, while it's growing at 3 to 5%, you can borrow against it, right? And I was explaining, when you borrow against it, that's not taxable. So if it's growing and I sell, that's a taxable transaction. We were talking about Wall Street. If I'm buying mutual funds from Wall Street and I sell them for income, that is a taxable transaction. Like I sold, right? Now, if I take a loan against, what was that, Nano?
If I made money at that point.
If I made money, yeah. If I made money, then I get to pay taxes. But with life insurance, I borrow against it. That's not taxable. See the difference there already, right? Now, the average mutual fund return, this is from Dalbar. They're a mutual fund rating agency, one of the top in the country. For the last 20 years, the average investor in the stock market after fees and inflation made only about a 3.88% per return annual. 3.88%. So that's the same between 3 to 5 over the last 20 years. Right now, you factor in the taxes, right? And then you're down to whatever you're down to, whether that's 2 or whether that's 3, it's dependent on your tax bracket. So you're basically looking at about the same money at the end of the day. You can't do all the same stuff with it. It's with Wall Street. It's not going to give you the same returns. You can't take the mutual fund, borrow against it at 90% of the value and put it into a real estate deal that pays you 12%. So I was explaining all this to this client today. I was like, so it's growing at 3 to 5. You take a loan, your cost to borrow is 1 to 3. That's interest you're going to pay. You're still making the 3 to 5, right? So if you're making 3 to 5 and you're paying 1 to 3, you're making more than it costs. And also on top of that, you're going to go invest at the 12% in these real estate deals, and then you're going to pay yourself back, right? This was the part that he was having trouble with. He's like, okay, well, why would I pay interest to borrow? And I was like, well, it's you're earning 3 to 5. So if you're going to earn 3 to 5 and take a loan at 1 to 3 and still keep the 3 to 5 and avoid the taxes, you're actually getting paid to do that. Okay, believe it or not, Apple actually does this. Their headquarters, if you didn't know this, is in Ireland. Okay, Ireland at the time they set up their headquarters was a tax haven. You could set up a corporation and pay no taxes there. So Apple set up to where their headquarters is in Ireland. All of their locations in the US are basically set up as franchises. All the profit flows to Ireland. And when they need to bring money back to the US, guess what they do? They take loans. They borrow against the cash they have in Ireland to avoid paying taxes in the United States because they know that loans aren't taxable. Even Apple is doing this, guys. Right? Banks do this. They borrow against their deposits. Right? You can do this. You look at wealthy family after wealthy family, corporation after corporation. They all do this in some way, shape, or form. So it's not a new thing. It's that's not something we were ever supposed to know about. Right? Like that, this was above my pay grade. I was never supposed to find this information out. Nano sure as hell wasn't. He's from Brazil. Right? Like I'm from Alaska. We're the last two people that should ever have found out about this, and we did. And now we're telling everybody. Right? So this is really like, you've got to look at it the same way I was explaining to this client. And then I was showing him, you pay yourself back. Okay. This is different than, I'm going to buy real estate and live off the passive income. No. That's for later. We're building wealth right now. So you're going to take the income from the real estate. You're going to pay your bank back. You took a loan, make a payment back. Now, when you pay your bank back, you can borrow again. So it's the same function as saving. If you have income, you're going to put it somewhere. So again, we're getting rid of the practice of giving money to a bank. Instead, we're going to give it to our own bank through paying back a policy loan with the income we're generating from the deal we did. And the result of that is we're making, 12, 13, 14, 15% annual. And then we're taking the loans out again. Every time we get another 50,000, we do another deal and we continue to recycle that through over and over and over. And what happens is this pool of money over here that we're borrowing against, it keeps growing like we never took anything out. And it's going to do that forever. And then over here, we're stacking up more and more assets, and that's going to continue producing more and more of the passive income. Right? But there's a way to do it correctly. And that's why we keep saying, get the book. Right? Like you're not going to learn it all in the webinar tonight. If you haven't gotten the book, this is the place to start. And then we'll walk you through the rest because there is a sequence to it. There's a right way to go about it. Of all of the life insurance policies out there that you can set up for this concept, there literally is one of them that works the way that I like it to. Right? Like of all the companies, you can do, Guardian, Mass Mutual, New York Life, Lafayette Life, Security Mutual. Like I can name off company after company after company. And of all of them out there, there's one of them that does it the way that I personally would do it for myself. And that's how we do it for our clients too. Right? Now, ironically, this company also pays the least. So most agents, even the ones that are selling infinite banking concept, they're not talking about Guardian. Guardian is the company we use because they make twice that to sell Lafayette Life. Right? You guys got to know this stuff. Right? Like when someone sells something, you got to think about, okay, well, why are they picking that one? Okay, I was in it. Like I related to working in a restaurant and seeing what goes on in the kitchen. I know what goes on in the kitchen. So I see this stuff. I'm like, okay, cool. I understand that this person has a better deal over here. That's why they sell this instead. Okay, for us, we don't care. Like we're gonna help clients, and we're not gonna do stuff that we wouldn't use ourselves. I only have Guardian at this point in time. Okay, I don't have other companies. Right? So if I only have Guardian, I have to look at, well, why? What am I trying to have? Well, I'm trying to have flexibility. I'm trying to have unscheduled, deposits. I'm trying to have index riders. I'm trying to have, direct recognition, non-direct recognition where they bump my dividends up. With Guardian, you can go either way. Like there's a lot of features out there that I personally want with a policy. I want to take loans on my app. I don't want to have to fill out paperwork. I don't want it to take forever. I want the company to be technology friendly, all this stuff. And that's why I go with that company, because that's what I would use. So why would we sell something different? Just that fundamental thing. Like with Wall Street, they sell something different. They do not use the thing they tell you to use. What are your thoughts on that, Nano?
So, I mean, for sure, right? It kind of goes back to, where you're saying, hey, first of all, we actually need to fund the account, the life insurance, this infinite banking concept. And a very key thing that you mentioned on this was like, hey, I'm going to borrow against my policy. Why? Because it's not a taxable event. Now, I do want to emphasize on that because usually that's the part where whenever I'm dealing with a person, I almost see it's like them trying to, okay, how can I actually understand this concept? Because it's a little foreign. Why? Because that's how banks do it, right? Where you say, hey, this company, right? Apple has money in Ireland. Now I'm going to borrow against it. Now, so you're going to do that. I'm like, why? But now I still have a debt, like now they're still thinking like a consumer. Hey, by the way, we got to put the thinking to the side, right? I literally have to think like a bank. Why? So I can have the result of such. So that's what we're trying to accomplish, right? It's almost like undoing first. And this is the kind of a thing, right? You get the book, right? And then you have some questions, right? Which could be normal, right? Why? Because I have been marketed to my entire life. Like, hey, I gotta do this, 401k example. The individual that I was talking with earlier today, same guy, right, had money in a 401k doing the rollover. But he's like, how am I gonna avoid taxes? Right? How am I going, what about this? What about that? I was like, and it was too much for me to say, within a 10, 15-minute call, like, hey, take a look at the information. But the bottom line is the very first thing that I need to be looking for when it comes to an investment is what? Preservation of capital. That's the very first thing. It's not even tax, right? That's almost like, hey, a trap. I'm going to put my money in a 401k, give up control for the next however many years, 20, 30, 40 years, right? Depending on how old I am. I'm going to give up control on it. And if we break it down, right, what's composed on a 401k, right? We have a couple of different parties. We have the custodian, we have the trustee, and we have the investment provider, right? Custodian, the place housing the money. Trustee, the place managing the money. The investment provider, the place where is going to be putting the money to work, right? Now, with Wall Street, they are all three. And guess how they make money? Again, a question that I got to be asking myself if I'm a client, right? With them, or period, right? Just so I can understand the game. How do they make money? And a person, and the guy's like, and I asked the guy the question, well, whenever they put, they make money with my money, okay, fine. But what about when they lose it? Do they still get paid? He's like, yeah. I was like, and it's almost like, it's not in a bragging manner, right? But just like, how about I confront things for what they are, right? I'm caught up with the idea like, hey, I need to avoid taxes because I'm going to be hit in my, in my income. Think about this. I'm concerned that I'm going to be paying taxes now. I'm giving that up, right, for the idea that I'm going to have enough money whenever I do retire. By the way, which is going to be, what if the market is down when it's time for me to retire? What is if the time does come, I don't have enough money there? If there's a crash, right? The 2008 happens again, which if you're paying any attention to what's going on,
it's going to
right?
happen. And this is really quick. This is a good point though. A lot of times we talk with people, Nano, where they didn't go through that. Maybe they weren't working yet, or they weren't anywhere near retirement yet. And so they don't have the reality and the experience that there are real people I've talked to that in 2008, they had to plan their retirement differently.
And that's not the
they thought it was going to be that year. They lost half. Right? Yeah. 2020, same thing. Right. So you look at this and it's like, okay, well, it's almost like playing a game of Russian roulette. Like, I'm pulling the trigger and hopefully the year that I need to retire isn't the one that the bullet comes out and I lose half my portfolio. Okay, because that very well can happen. Now, the other thing Nano said that I want to highlight and pinpoint is that, when we invest, we are really going for first, not losing, right? Preservation of capital. Okay. And when you invest with Wall Street, you invest with mutual funds. One of the first things that they have to tell you is this is not guaranteed against loss. They'll tell you that it's not guaranteed against loss. You sign a bunch of paperwork, basically in fancy lawyer language, saying you understand that they probably could lose all your money and that they're not held responsible for it if it happens, and you're still going to pay them the fees, and they can't guarantee performance and all this stuff. Okay, so we invest primarily for not losing money, and that's the sacred account. The life insurance is not an investment; it's insurance. So because of that, they can guarantee you won't lose money. And they actually have a 150 plus year track record of showing that. Right now, Nano mentioned tax benefits. We don't invest primarily for tax benefits. Why? Because if you want tax benefits, just lose money. Right? You can write off a loss. Like if the tax benefit's the primary thing we're going for, like, okay, the easiest way to do that is for you to go lose money. And then you can be like, cool, I have a loss. I'm going to write it off against my capital gains. Okay. So we don't want to do that. We want to look at what do the wealthy actually do. Now, Nano had mentioned with banks. Okay, so the number one owner and purchaser of life insurance is banks. Okay, over $200 billion of their reserves collectively between the largest banks in the United States are in life insurance policies like what we're talking about today. Right? That tells you something, guys. They're the number one owner and purchaser. Like it's like think about it in terms of restaurants. Right? We all have a favorite restaurant, right? Nano, what's your favorite restaurant?
I mean, there's one that I really like to go to. Just I don't know. I kind of grew up going there. Chili's, for whatever reason.
Chili's. Okay.
Yeah.
I remember when I was little, I thought Chili's was so fancy. I thought I would never eat there. I was like, Chili's and Olive Garden. I was like, that's for rich people.
Yeah.
But okay, so Chili's. So there's a difference between Nano liking Chili's and being the number one purchaser of Chili's. You see what I'm saying? Like, that's a different level. Like, okay, I like life insurance policies versus I'm the number one purchaser and owner of it. I like Chili's, or I eat at Chili's more than anyone else literally in the entire world. Right? That's a different level. So we're saying with the banks, that's the level they're at with the insurance policies. Number one owner, number one purchaser. They're the number one in the entire country at buying and owning these things. And when they do it a specific way for a specific purpose. And so we have to look at that, and we have to look at, again, like Nano said at the very beginning of the call, like who's winning with it, who's succeeding with it. Okay, the people that are winning with it and succeeding with it are the same ones that are marketing billions of dollars for us to give them our money. And then they're going to go stick it in a life insurance policy anyways. Right? Like when I was 18, I learned this concept. It's called bypass the middleman. Right? And it was talking about banks. It's like, you're going to take your money, you're going to give it to a bank, and then the bank is going to go invest it, and they're going to pay you nothing. Well, you can invest in all the same things the bank can. Why not just cut them out and you go directly do those things instead? Right? And it clicked for me because I was like 18. I was like, yeah, of course that makes sense. I didn't have all of the, all of the confusions that people have when they're later on in life with finances. I was like, man, that totally makes sense. Why don't more people do that? And it actually took me years to answer that question. The reason why more people don't do it is, first of all, they're so out of control with their finances day to day that the idea of having to learn something new is overwhelming. Right? The average American has less than $1,000 saved. Right? They don't earn more than they spend. They've got tens of thousands of dollars in debt. Right? And so they're just trying to like survive. They're like as far as like how far out they're looking, they're like here. Right? They're looking 3 inches in front of their face the whole time because that's how survival is right now. I've been there before. You're not thinking strategy when that's happening. Okay. Now, in order for them to learn something new, that also means that they have to increase their level of responsibility. Right? I have to say, okay, I'm willing to be responsible for more. I'm going to make better financial decisions. I'm going to go earn more income. I'm going to spend differently. I'm going to be on a forced savings plan. Those are all asks, us telling you, if you're a client, you need to be more responsible with your finances.
And by the way, just on that point, Jerry, right? These are the things that we can actually control. My willingness, my attitude, which will lead to my behavior. Because a lot of this is like whenever you become a client, right? One of the very first things that we help you go over is actually something called the personal financial purge, which is to help the individual get rid of behavior that it is counter to them actually building wealth. So let's say that that's one of my goals, right? As Jerry's mentioning here, I gotta increase my level of responsibility, which would mean what? To a degree or another. I gotta learn about this, which could be also demonstrated by you attending a webinar, right? Okay, getting the data so we can actually be able to apply it. So I just felt like that was very fitting to what you're saying there, Jerry.
Yeah, and that's a perfect tie-in, because when I was with Wall Street, and if you're with Wall Street now, think about this. You don't have to do anything. When is the last time you had to learn something where your financial advisor was like, hey, read this book? Never. Like, that's not a thing. They don't want you to read books. They want you to remain uneducated. Right? So the knowledge thing isn't there. For us, that's the first thing. We're like, hey, you can't even be a client with us if you're not going to read the book first. Like, that's a requirement. Once you get a Sacred account, we have a course you have to take. Before you can have your account, you have to go through a course. We make you take the course. Okay. It's not any different than if you're going to drive a car, you have to go get a license. You got to study and learn about it. We're not going to be like, great, here's a car. Like, imagine if car dealerships were in charge of driver's licenses. How big of a conflict of interest would that be? Right? But that's the equivalent of you're giving all your retirement money to Wall Street. It's the same thing. Go ahead, Neno.
No, just like if they were responsible for handing out a driver's license, like pass every time. Right?
Every single person would be passed. Here's your keys.
Pass.
Yeah, and they'll sell you the insurance too. So guys, like, when you look at this, like the desire to give knowledge isn't there with the Wall Street system. right? The responsibility isn't there. You're literally giving up control of your money till you're 60. Like nothing is less responsible than giving control up entirely. Right? Like the mindset of the individual that invests with Wall Street. I don't want to see it. I don't want to think about it. I don't want to manage it. I just want it to be there. You make it grow. Tell me what it did. And I'll talk to you when I'm 60. Hopefully I have more. That's literally how most people think with this. Right? That's the lowest level of responsibility you could have with your money. We're telling you, okay, you need to look at it every day. You need to check your accounts. You need to do a budget. You need to increase your income. You need to learn about investments. You need to learn about the tax code. You need to actually have a plan. You need to follow the plan. You need to do check-in calls with our team, right? It's all this responsibility and people shrink back from that, right? Because they're not used to it, especially with finances, because all anyone has ever told them is you don't need to know anything and just let us do all the work. You don't need to be responsible whatsoever. Just trust us, right? And then that leads to the control going down. You don't have control over it. And that's evidenced by try and get your money out of your retirement plan at work tomorrow and see what happens.
The definition of a financial trap.
Definition of a financial trap, one you can't get out of, right? Like, and this is even with banks. We had a client in July, they did a $500,000 gold order. Their bank, like this is the client's money, right? Like supposedly this is their money. They sent it to the bank. They kept it in the account. They're like, hey, I want to buy gold. And the bank's like, okay, cool. Well, first you can't because we need to call the Federal Reserve and ask for their permission. And then if they say yes, then you can, right? Like, think about this. Like, that's not control, right? Like if I put money in there, it's supposed to be my money. It wasn't the Federal Reserve Bank's money. They didn't earn it. It wasn't something that they went to work and did my job or they made smart decisions. And now all of a sudden it says, why are we asking them for permission? Right? Like imagine if this was you being able to leave your house and you were like, I want to go out to the store and someone's like, okay, cool. Real quick, we just have to go ask the mayor for permission so you can leave. Right? Some people, this is eerily familiar to 2020. But that's what it's like with your money, right? So you want control. And if you have control, then you can do the right things. You can have the passive income. You can build the wealth. Without control, you can't do it because the people you're giving control to are doing it for themselves with your money. You can't both be doing it with the same money. It's either you have your money, you have control over it, and they're not touching it, and therefore you're getting the wealth, you're getting the passive income, or they have control. They're going to get the passive income. They're going to build wealth. They're going to give you the leftovers, the minimal possible leftovers for them to be able to keep as much as they can. And that's really what it comes down to. So I know we're running short on time here. Nano, is there anything else you want to add to this before we wrap up?
So with this, right, it's like, okay, gotta have my willingness to confront things for what they are, right? So whenever we talk, just a simple fact, right? Jared just mentioned it. Now, this about the bank, this individual that wanted to, his money, deposit in the bank, wants to get out. Now it's an issue. Here's another piece of data, right? That people are not aware. Whenever you and I deposit money in the bank, I am no longer the legal owner of the money, which is probably one of the issues now, right? That this individual is bumping into. Since I'm no longer the legal owner of the money, now I become what, right? The bank now owes me my money to me, right? And guess what? They don't have that money there anymore. They're loaning it out as fast as possible, which is a bit of an issue, right? If now imagine you and I, or everybody trying to take their money out from the bank all at once, will be a problem because what? They don't have their money there. They're loaning more than what they have. If I don't confront that's the case, I can rest on the false idea my money is safe. A client comes to mind right now, and Jerry probably knows this, you know who I'm going to be talking about, right? We're trying to help this guy get some gold for a couple of weeks, right? The guy has been following us for a few years, and for whatever reason, he said that wants to do it, but doesn't pull the trigger, right? Which it's fine, quote unquote, until it is not. Because if I am resting on the idea that my money is safe when it really isn't, there's something that I'm not confronting for what they are, right? So it's fine until it is not. And if I take a look, again, historical data, it can be a problem whenever, like, excuse me the language, when shit hits the fan and I try to get my money, I don't have access to it anymore. Right then, it's not so fun anymore. Then it's like a problem. Oh man, I should have done this, right? Then it's like what, 2008, when it's like, yeah, I know, I'm fine. Something happens out of my control, right? I'm planning, I'm doing everything that I've been told that I was supposed to do, and shit hits the fan. Now what? Right? So how about I just confront things for what they are and I take action, right? And I simply have to look. I gotta be willing to look. That's what are the wealthy doing? Let me just go ahead and do that, right? So that's my what I would have to add there on what you're saying, Jerry.
Yeah, and I want to just add to that before we wrap up. You know, like when you're at the lower level of building wealth, like Nano said, like with banks and stuff, it is a financial trap. Like it is something where you lose control. When you get up into the higher level, they still try and keep you there, but they can't do it through the same like manipulation and stuff. It's now they give you extras, right? So I was talking to a guy yesterday. He's got a several $1 million net worth, and his whole thing has been like, yeah, you know, I bank with JP Morgan and I bank with, you know, Chase, and you know, it's awesome. And I have my own account rep, and they help me every time I need it, yada, yada, yada. Until he did something they didn't like, they froze all his credit lines, and they're like, good, we're done with you. Right? Like it's not when you're working with banks and Wall Street, it's not a reciprocating relationship, right? Nano's mentioning this particular client, whatever feelings he has towards his bank, I promise you that the owners there don't even know his name. He's a number on a spreadsheet that's going to add to their bottom line. As soon as that doesn't work anymore, they're going to burn him and throw him out on the street and say, sorry, we don't want to work with you anymore. Right? And if you think about what perks are you actually getting? I have my own account rep. You get that with us, like day one, no matter what size client you are, you have somebody you can call anytime, right? Oh, I can call them on a weekend. You can do that too with us. Like Nano just said, he's got clients that text him like randomly and he'll send them articles. That's even better, right? And when you look at it too, it's like, okay, well, what are you actually getting from a product or service? You're not getting much different, right? They're going to try and sell you the same shitty mutual funds. They're going to try and keep you in their accounts. They're going to try and do all the same stuff. So you have to look at, okay, well, I can do all this stuff anyways. What benefit am I getting? And for me, there isn't one. And that's why it's like, okay, good. I want to become my own bank, right? So for those of you that are watching, if you don't already have a Sacred account set up, I want to encourage you, reach out to Nano. Okay, reach out to Nano, get on a call with them. You can start with the book. You don't have to get on a call first if you don't want to. Get some information. You can go to jerryfetta.com/B2F. You can get a copy of the book. Actually, go to jerryfetta.com/B2F promo. That's going to give you a better price. jerryfetta.com/B2F promo. You can get the book. That's going to give you some data to get started with. And then from there, you can start working with our team. We'll answer your questions. We'll get you set up. We'll help you, figure out the sequence and the planning side of things. And that's that. And then you can actually start building wealth. So without further delay here, I want to just see if we have any questions to answer. I don't think we had any in the chat. Let me just check Facebook real quick. All right. Good to see everyone on Facebook. Larry, Justin, Steve. All right, I don't see any questions on Facebook either. Justin says, I love my Sacred account with Guardian. I do too. Guardian is awesome. Good. So I think that covers it. So before we wrap up, Nano does have a call on Monday. Okay, Monday, 4 p.m. Eastern time. Nano, what's your topic going to be this week?
So this week, we're going to be diving into the mortgage industry. Now, funny enough, here we go with marketing again. Since 1930s, there was an incentive from lobbyists going into legislation to be pushing this idea, right? Related, right? Attached to the American dream. If you own a home, that's you being patriotic, right? Think about this idea being pushed from a systematic standpoint. And all I'm going to say right now, right, it is whenever we take a look at the definition of the word mortgage, the root word means a death pledge. Think about this, mortgage. The root definition of the word means a death pledge. Another financial
That's
trap.
Intense. Let's just pause and appreciate that for a second. Even if you're not actually pledging for your death, for them to call it that is intense. Like that's like next level, right? Like that's like you and Nano being friends versus him being like, we're blood brothers. Like even if he doesn't make you slit your hand, it'd still be weird for him to call you that, right? Like that's I just want to make sure everyone has that sink in, is we're calling it a death pledge. That's what it's called.
So that's what it is, right? So that would be literally the definition of what? Of a financial trap. Now, if you're getting a house, if you're planning on getting a house, right, you may be bumping into like this number of things. I'm like, well, I need a place to live, yada, 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 all of that, right? Which is fine. There is a different way that can actually be done, right? Which it's a whole different subject. It's inside the book, right? There's like hours and hours of content that we can kind of dive into and help you with this. But that's what we're going to be talking about on Monday.
Awesome. So guys, we'll wrap up here for tonight. If you have questions, reach out to us. We're totally open to do call, email, whatever you need. I know Nano put his email address in the chat. You can email nano@wealthdynamics.com. You can also go to our website and reach out. And again, guys, if you didn't get the book, get the book. Okay. This is jerryfetta.com/B2F promo. Otherwise, have a great weekend. We will see you guys again next Friday. Nano will see you guys on Monday, and we'll talk to you next time.